All right, what's going on, everyone? So, in the last few videos, we've left off on the actual full market cycle and looking at a few examples of the market cycle playing out, as well as, in our case, some very, very rewarding base market cycles where the entries that we actually had ended up in huge deliveries in the market, which, of course, we all understand is not something that is common nor something that we should expect out of the market, because, again, these are outliers, or these are examples of things that have just continued to go and go and go. But the beautiful thing behind them, and the way that I want you to start to frame your frame of reference from which you're going to build an edge, is that if there is a move like this, or some move like this, or even half of a move like this, if you can take one trade or one good trade, two good trades, whatever it might be, and do so consistently, do you think that over time you'd be able to make money, right? If you were able to find a moment of a cycle as it's delivering on an entry-based time frame, so whatever time frame that is, and get positioned inside of one or multiple of these kind of MBs and then manage yourself, do you think that is a style of trading that would lend to a good system? And the answer should, of course, be a resounding yes. And once you've recognized that, what's beautiful about that is that as you follow rules that create moves like this, that create moves that may go on to make even larger moves and make you money, as this becomes clear, what'll happen is you'll allow yourself to catch moves like these ones here, and they will occur, and you'll be able to spot them, to find them, and to, in many cases, ride them out, if not even ride them out multiple times, because a lot of the time you may get stopped and redo an entry, right? So like an example would be that you get your entries inside of this little move here. Within that move, as you go and go and go, you may, as this is the move, get stopped around something like this. This kind of move here could stop you out, or a move like this right here could stop you out. Upon getting stopped out, we all understand that a cycle may repeat. And in the case that a cycle starts again and starts going, you have new opportunities for entries, new opportunities for entries, new opportunities for entries, new opportunities for entries, which will then go, 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 go until they might stop you out, at which point you get new opportunities for entries. And over again, this goes and goes until you get true failure, or failure that leads to inefficiency, or a market that is not worth trading anymore, right? It becomes a worthless market. So what's beautiful is, as you're learning, you should also be spotting the fact that you are given tools that let you position yourself anywhere within a good moving market, and to get yourself in, to take your edge out of it. And again, if you can ask the question of, do you think you can take one or two trades out of this, or multiple that overall amount to being positive on your account? And if the answer is yes, then you already have kind of made a switch in your own trading, in your own thinking, in your own thought process, against most other traders, in that you recognize what an edge looks like and how to actually take money out of the market. And not only that, but you've learned how to do that across any time frames, because you have, for the first time, likely learned that the approach that is being taught here, and the actual approach to markets, is that, hey, it happens on every single time frame, and it happens the same way. And we have proof of our own members, of myself, of multiple people that have already reached the levels that you're looking to reach, that have done it across multiple timeframes. We have funded members on the 15 seconds and lowest of timeframes, and 5 seconds and 1 second. There are people on the 4 hours on cryptos doing very well. There are people on the weeklies doing very well. You have the entire boat. And what's beautiful about that is that the actual choices now are lended to you. You have the choice of how to pursue the move forward. Okay. Now, what I want to do in tandem with this now, because you've now understood that you have a ton of opportunity in regards to entries when you have a full cycle playing out, is I want to look directly at this important note that I asked you to remember earlier, as we looked at full cycle examples. So in our full cycle examples, we spoke a little bit about entries, where an entry might have been, and then about all the other stuff. Where could your stop have been? How could it have looked? Where could the entry be that ends up delivering the full market cycle? Because we understand demand validation and how that might look across timeframes. The starting point that I asked you to write down or to remember is that your current understanding of entries should move as far as we buy an MB. And this is, again, assuming the bullish side. Please remember that as we do this, everything is just flipped for the bearish side. And right now, what I will offer is that the reason I look a lot on the bullish side is because when I'm looking at something like a crypto, like a stock, like a future, a lot of the time, the way that thing functions is that there is a zero. There is a zero asset-based cost that can exist, which means that over time, given that value within that given asset class or equity or stock or current or cryptocurrency is going to somewhat over time increase, right? So a lot of the time, what I found is that it is easier to arm yourself to trade the long side in most asset classes due to the fact that to get back to zero is a lot harder and you can't make as much as it does when you have upside potential. Because on the upside, you could move 500%. On the downside, you can always move 100%. So it's something to remember. And the only place that that is not true for the most part is Forex, right? So in the case that you're a Forex trader or an extremely lower time frame trader, the reality is a lot of the time you're going to arm yourself to trade and understand how to get involved on the long side, right? Because if you're on a low time frame, just very quickly to showcase this, if you're on a lower time frame like a 15-second, well, the down cycles or the cycles of down movement are going to be pronounced and very, very clear, because a huge down cycle that goes from this point all the way down, resets, goes a few times, market flushes, goes through the MBs, keeps going. That entire thing may move price from a price like 18,711 to a price like 18,000. Right? And that's a very easy move to occur. But if you're trading a much higher time frame, looking for continuations of full cycles on a mass effect to the downside, so this actually goes back into some of our discussion about the positives and negatives of EVC, right? Doing so on a higher time frame of an E and looking for the overall cycles that just keep going for months and months or years even on the downside is not going to be as clear as the upside, because what we need to remember about most asset classes is they have and come from a zero level. And those assets that come from a zero level, for the most part, means that you are arming yourself to look for this, but you're also arming yourself to look for this so you're ready for when this occurs and can walk away, or recognize worthlessness, or recognize when a market is no longer potentially clear for following, because it might go into either a down cycle that might last a little bit of time before a continuation higher, or goes into chop that is not worth trading, right? So this is actually now one of the reasons that you've been learning thus far to think in the bullish scenario, okay? But remember, as we do this and the lower the time frame of the entry that you go, the more likelihood you have of trading the opposite side as well. To show you a very, very basic example of this, right, is if we go to something like NQ, which is basically NASDAQ or the US 100, whatever you want to call it. This is just the future version of it. If we go to something like a 15-second on it, right, and we look at this, what you're going to see, and I'm just going to find good examples of this occurring instead of looking, you'll have up cycles. You'll have many up cycles that will move clearly and that will give you opportunities on any given day. Because remember, right, lower time frame means everything's faster, means everything happens faster, and this would have been all in one day, right? This is over 2 hours. And for some people, this might make their entire year just being there for a move like this, okay? But at the same time, in the event that you do have some kind of actual, okay, so another beautiful upcycle, right? So again, a lot of you can think about what would be available inside of here in terms of the full cycle of what we've been teaching. But similarly, right, you'll have full cycles on the downside, right? You'll have full cycle, and this one might not be one that's super huge, right? Others will continue much larger and further. But something to add to your notes or to recognize about your entry-based time frame is the lower your EVC, the more likelihood you will actually have in catching both the long side of the market and the short side, especially if you're looking at a lot of assets, right? Because then you open yourself to looking at cycles that exist on both sides of the market. And as a result, you open yourself to the potential long side of a market, and you open yourself to the potential short side of the market, since a move like this to occur on a weekly, for instance, is a lot harder due to the kind of asset class we're looking at, right? So again, this is more so a very deep look into some elements of your trading system. And I want to teach this at some point. So this is where it's going to happen, right? Where if you notice this, right, even on a weekly, you will have potentially down cycles. But after down cycles complete and let's say up cycles start, those up cycles, right? So this was, just to show you this was 2000, the year 2000. We had this run up and then we started this kind of down cycle that maybe you'd pick up on maybe around these points here, or maybe even these points here. And you might catch some of that move that ends up not really moving much, right? Because again, for this to continue a big down cycle that goes and goes, this thing has to go negative, which is not possible for an asset that in nature starts at zero, or it can only be at zero, okay? And then all of a sudden you get these up cycles, you get the full cycles to the upside that go and go and go and go. And then you do get some intermediate, some shorter term down cycles, as you can see right here, but then you start new up cycles. So these down cycles become part of the up cycles that are actually occurring, right? So, you know, the classic thing where the up cycle is just continuing through some version of a flush out, and this is just a deeper flush out, and it continues that given up cycle, right? And the reality is to start a real down cycle, which can happen, right, where price goes and goes, and maybe flushes and goes and goes and goes, for it to make a down cycle that is tradable on a higher entry timeframe EVC, right, it has to do something like this. And for that to occur, if you notice, it would mean that the US market has lost over 70% of its value, which is hard to do. And that's hard to do for any given asset class. You know, for the most part, it's very hard for an asset class just to do that consistently, which is why the starting points of this course have been to focus on the long side, to get you equipped with the long side, so that those of you that choose to prefer and trade higher base timeframes will oftentimes learn to do so on the upside. Likewise, for those of you that choose to trade a much lower timeframe based approach, you also are now armed with the ways in which you can look for the downside, which is the exact same thing on the full cycle, which will occur more often due to the fact that a few weeks of down moves like these mean overall cycles playing out on a 1 hour chart, on a 15-minute chart, on a 5-minute chart, on a 1-minute chart. So that's where those entries, right, are more, you're more capable of taking these shorts, right, where the shorts become easier to take, where you sell the market overall, right, you're selling the market. Similarly with Forex, that's one of the assets that you can do that with. So that's something that I think is very important that we understand and that we cover. I actually am going to pause this and start the next part in the next video. So this is just a standalone that you understand as an added benefit or disadvantage, however you want to view it, of the, here we are, of the higher or lower you go E-based time frame. So the lower you go on the E, the more opportunity you have, which we've already discussed, right? The more opportunity you actually have to go long or short, right? Because you have more prolonged bearish markets that actually play out in a clean way, right? Instead of me trying to look for a move like this, where a given asset is going to lose 80% of its overall market value, so I can get in potentially inside of some area here and then take this down, that's a lot harder than me, for instance, let's go to a 1 minute on even gold or something. So here's some gold, okay? It's a lot harder than me looking for and trading, let's say, a down-based market cycle, which this hasn't had in a while. So like we're going to be going left a little bit here. You know, you have some up cycles that are very clean, but there are some down cycles that are much easier to happen, right? For a stock or a crypto or an asset to do something along these lines, right, where it makes a move like this would have to lose over 80%, 90% of its value. Versus if you're on a low time frame, like a 1 minute, for this to happen, it's nothing crazy. This is losing 1% of its value, which happens every single day. This could go on to lose even more value. This could go on to go through a full cycle, right? So it starts a move. This might have another flush out, go through another move, go through a flush out, go through another move that then becomes a crazy move that becomes an even bigger move that then flushes up, major flush, maybe it starts to, but then it flushes, right? For it to do something like this on this crazy high level, that's this asset losing only 3% of its value, which is an easy thing to do, right? If we go to a higher time frame and we really just study this market, this thing loses 3% of its value in some cases every single few weeks, right? Here it is lost 4%, 6%, lost 10% of its value. Here it lost 3%. Here it lost another 3%. Here it lost 3%. Here it lost 3%. Here it lost 3%, 3%, 6%, 6%, 6%, right? So if you're in a lower time frame, having full cycles, a full market cycle of the downside playing out is a lot easier to expect than a full cycle to play down to the downside on higher time frames. So that's something to add to your repertoire, to your understanding of opportunity. And once that's understandable, we can now move to the next step of looking at actual entries. So this was the intermediate video before the entries, and now we can get into specifics around the entries. Let's do it.